Welcome to the latest Hardman Talks on Chesnara. I'm financial analyst Brian Moretta, and today we are joined by Chesnara's Chief Executive, Steve Murray, and its brand new CFO, Tom Howard. Tom, as is your first time here, we thought it would be a good opportunity for you to introduce yourself to shareholders.
Brian, thanks. And look, it's absolutely great to be here. I think, as some of you might know, it's pretty recently I joined Chesnara. I think this is week 7, actually, not that I'm counting. But really excited to be here. I spent a large part of my career in life insurance. So I spent 14 years in Aviva before coming into Chesnara in a variety of subsidiary CFO roles, and also some roles within corporate development and M&A. So just really looking forward to putting some of that knowledge and experience to hopefully some good work in Chesnara.
Great. And it might be helpful to give an idea of what actually attracted you to joining Chesnara, because presumably you have several options.
Yeah, well, Brian, particularly as a CFO, I think one of the things that you look for as a really important hygiene factor in a business is financial strength and delivery. So I feel really fortunate to be joining a business that has a really strong balance sheet. I think we saw in the last set of results, very, very strong solvency ratio. I think we've also seen a really strong record of delivery and a return of value back to shareholders over the last 19 years in the form of a progressive dividend. So actually coming into that sort of environment is a really positive thing for any prospective CFO. But I think actually fundamentally it was just the discussions with Steve and the board and the level of ambition that Steve and the board have for the business that was, the really defining factor for me when I was making that decision.
Okay, great. Thanks, Tom. So now Steve will give a short presentation, which we will follow up with a Q&A session. So Steve.
Thanks, Brian, and thanks everyone for joining the session. We'll give a kind of quick précis of the full year 2023 results. If you want to see the full version and some of the Q&A that we did back in March, you can go to chesnara.co.uk for the full unadulterated version. Now, we're conscious some of you joining today may not actually be aware of who Chesnara are, so I thought I'd start with a very brief introduction to Chesnara that we set out on this slide. So we listed 20 years ago on the stock exchange, initially as a UK business, and then we've grown further across Europe. So we're in 3 territories: in the Netherlands, in Sweden, and in the United Kingdom. We write new business in Sweden and the Netherlands predominantly, albeit a little bit now in the UK after our Sanlam acquisition. Split around about a third in terms of the value of the group across those different territories. And you can see on the right-hand side that we have 3 clear strategic objectives. So the first one being maximizing the value from the existing books of business that we have across these geographies. We look after the life insurance, pensions, and other wealth management products of almost 1 million customers across Europe. And if we don't do that well, ultimately we don't have a right to continue with the rest of the strategy and the rest of the strategic objectives that we have. The second key strategic objective for us is acquiring books of business across Europe. And we've done this pretty successfully over the last 20 years. And we think this is something that's more unique to Chesnara perhaps than other insurance companies that you might follow. And thirdly, as I alluded to, we do write new business where we think there's a high degree of possibility that we can write that at a profit. And we're doing that in a very focused way in terms of writing group pensions business, predominantly in Sweden, term insurance business in the Netherlands, and we do write some onshore bond business in the UK now as well. So hopefully that's a useful overview around who Chesnara is and what we do. Let's move now onto the results, and we find this is a slide that particularly our retail investors find very interesting and also very attractive in terms of one of the key parts of the Chesnara investment story. So you can see here an uninterrupted track record of dividend growth over the last 19 years, as Tom talked to in his summary. We think this is unrivaled in our sector, both in the UK and across Europe, and is a key part of the story. And as part of our results this year, we yet again announced another 3% increase in the full year dividend. So this is a slide that we're very proud of here at Chesnara. Looking then now at what we think that investors can expect from Chesnara, we talk about kind of 4 key things that we're looking to deliver as part of the renewed growth strategy that we set with the board when I joined as chief executive over 2.5 years ago. So firstly, we think that you can expect economic value growth. We've got a number of levers available to us, particularly M&A. And when we grow that value, ultimately it turns into cash generation that supports the dividend policy that we have. And we've got a strong track record of that coming through the results over the last 20 years. Tom alluded to the strength of the balance sheet in his introduction. We continue to have a strong Solvency II balance sheet position, and that's been very resilient to a wide variety of market conditions that we've seen over recent years, including the global financial crisis. The third area being M&A. We've executed 5 deals in the last 2 years, and we're starting 2024 with a positive M&A pipeline, and we think we've got a good track record of delivering value for shareholders from this activity. And then finally, and we would say this, we believe we've got a strong management team. We've added to that management team over the last 12 months that's very focused on delivering sustainable value for shareholders. And that ambition is shared by the experienced board that we have here at Chesnara as well. So let's turn now to the results and some of the things that we've been doing over the last 12 to 18 months. So on the M&A side, we completed the acquisition of a portfolio of insurance business from a financial services group in the Netherlands called Conservatrix. That happened on the 1st of January in 2023, and the integration of Conservatrix is now complete into Waard, which is our closed book consolidation business that we have in the Netherlands. Then over the period, we also announced the acquisition of a portfolio of protection business in the UK from Canada Life, and the integration of that business is going well after we put in place a reinsurance agreement in May to transfer the economic value of that to Chesnara. In terms of the financial results, it really was a clean sweep on the core metrics that we have, with all of those going in the right direction compared to the full year results in 2022. So we saw improved commercial cash generation of 53 million. This strips out some of the technical adjustments that you sometimes see in an insurer's results, and that provides ample coverage for the dividend. We also grew economic value in the year. You might remember, those of you that followed us back in 2022, that we did see a fall in the economic value of the group, predominantly because equity markets fell during the period. So it's pleasing to see growth coming through, and that was driven by the M&A activity that we saw in the period and also improved market conditions. The solvency ratio at 205% is the highest that it's ever been, and that's well above the normal operating range that we tend to look to here at Chesnara of about 140 to 160%. That provides a lot of headroom for potential M&A activity looking forward. Commercial new business profits were slightly up at 10 million, and we saw a contribution from the UK for the first time. And as I talked about earlier on, the dividend was again increased at 3%, and that's the 19th year of consecutive rises that you've seen if you've been a shareholder here at Chesnara for that period. Looking then at the operational delivery, it's been a very busy period for us. So in terms of the Sanlam acquisition that we made 18 months ago, the Part 7 transfer of those policies into Countrywide Assured, which is our main UK insurance legal entity, that completed in September. So we now have all of our UK products and customers in one legal entity, and we saw some benefit in the financial results from that Part 7 transfer within the full year 2023 results. Work's progressing well on the migration of administration to our new strategic partner, SS&C Technologies, who we see as a key outsourcing partner for policy administration in the UK. And we also see that agreement that we've reached with them, which is a long-term agreement, as being a key enabler for our UK M&A strategy. It kind of seems like we're underplaying IFRS 17 to a certain extent, given the effort over the last 6 years, having it just on one line on this slide, but we successfully reported on a full year basis for the first time under that new accounting standard. Consumer duty has been something that we've seen a lot of press coverage around in the UK. We're on track for the consumer duty deadline for closed book businesses in the UK of July 2024, and we're not expecting any material commercial impact when that deadline comes in this year. We've executed some management actions in the period. So we put in place a reinsurance contract, protect ourselves against mass lapse risk. And we also broadened the group FX hedge that we put in place last year as well. And both of those have helped cash generation across the period. Tom's obviously joined us this year, as you heard in his introduction, and we've also strengthened the leadership teams across 3 of our businesses, bringing in new CEOs for CA in the UK, Skilden in the Netherlands, and also Movestic in Sweden as well. And all of those CEOs have started well, and we're looking forward to them driving the strategies of those business units forward in 2024 and beyond. And on sustainability, we announced some targets last year, and we've also announced some additional interim targets in 2024 as well, looking at the emissions from our investment portfolio, looking to reduce those by 50% by 2023 for those emissions that we have direct control or strong, those assets that we have direct control or strong influence over as well. So overall, a huge amount that's been achieved in the period operationally against the backdrop of a strong set of financial results. I've talked about some of the key metrics already. This gives you an overview of the key metrics as we see them on the slide. We've also seen a growth in the funds under management of the group, supported by equity market growth. And one of the things that we've also introduced this year off the back of IFRS 17 is some new metrics that shareholders can track us around, including one that we're calling IFRS Capital Base, which adds the CSM that we see from insurance products to the IFRS equity position, and helpfully that's grown across the period, as you can see. And one of the other metrics that shareholders have been interested in is our leverage ratio, which has also come down under the IFRS 17 regime, and is absolutely in line with where we would like to see that leverage ratio going forward as well. This is a slide, again, that shareholders have been interested in. So I think they're impressed by the 19-year track record, but some of the questions that we sometimes get are, if you've paid an increasing dividend for 19 years, isn't there a kind of dividend cliff coming sometime in the future? And what this slide seeks to do is to show investors why we're so confident in the 5-year cash generation position of Chesnara. And we look at these kind of 3 blocks on the left-hand side here that are in the kind of purple color to show where some of that cash emergence may come from. So we see the natural unwind of the risk margin and SCR associated with the insurance policies that we have. We potentially benefit from investment returns that are above a risk-free rate. And then finally, we've got management actions available to us, such as the mass lapse insurance that we put in place and the FX hedge that we widened this year as well. And these boxes are drawn roughly to size and give you a kind of future cash generation potential of around 300 million. And that's well in excess of the potential payments that we could make with an increasing dividend policy and also the debt servicing that we have to make as well. And it's important to say here that there is no runoff of transitionals that comes through as a negative here. There's no benefit expected in these numbers from future acquisitions, which would add potentially to cash generation. And there's also no benefit assumed here from new business that we write, which ultimately should add to cash generation as well. So we think this is a good way of demonstrating the cash generation potential for investors. Turning now to M&A, again, it's another area of interest that we see from investors as well. We've talked about some of the key trends that we're seeing both in the UK and across Europe. And whilst in the probably larger part of the market, we've seen less activity, you're still seeing a number of portfolios coming to the market. And some of the key drivers for that are on the left-hand side. So we see large global insurers continuing to try and deal with legacy outsourcing agreements, legacy platform issues, and trying to simplify their operations. We also see them trying to perhaps sell portfolios of business, get a release of capital that they can reinvest elsewhere. And in the UK, quite often that's in the UK BPA space, which is a large trend that we're seeing. And we're just also seeing people being a little bit more discerning about the geographies that they've been in. And large groups have grown their geographic positions over a number of years. And we're seeing a number of people trying to reduce those down and reduce the complexity of the group. And from our perspective, those trends are quite helpful because they're far less reliant on macroeconomic conditions than perhaps you might expect. And that's why when we look at 2024, we're continuing to see a positive pipeline and a number of things that we can look at. This then also shows how we view Chesnara's position and why we believe we continue to be in a strong position to execute M&A. So there's a number of key strengths that we've highlighted in the top left of this chart. We've got a good record around customer service. We're able to manage a very broad range of products. We've got good relationships with the regulators that we deal with across Europe in both the Netherlands, Sweden, and the UK as well. And we have a very flexible approach that we can take to deal making depending on how we want to work with vendors. On the top right-hand side of the slide shows you the sort of considerations that we work through when we're thinking about financing a transaction. So we want to ensure that Chesnara continues to operate in its normal operating solvency range of 140 to 160. Our investment grade rating is important to us, so we'll keep a close eye on the leverage position that potentially gets impacted by M&A. We want to ensure that we retain enough liquid resources at PLC level that we can pay a year's dividend coupon and also support the working capital requirements of the group for around a year. And if we had all of our Christmases together, ideally we'd also like to retain firepower for other transactions as well. So hopefully that gives people a sense of how we think about the financing of acquisitions. And we talked to investors in March about the fact that the pipeline, if anything, we were starting to see larger size deals coming through that transaction. Stood here today, we have readily available resources if we include the RCF that we have at a group level of around 200 million. The balance sheet potentially has further capacity to raise debt. And of course, given that we're listed, we could also look to shareholders to support deals as well, if that was something that was kind of larger scale and more transformational for us as well. So just to recap, it's been a strong period of financial performance. I'd particularly highlight the commercial cash generation of 53 million and the underlying ECV growth that we've had of 59 million over the period. We've strengthened the leadership team. We've executed another 2 deals, and when we look at 2024 and beyond, there's a strong acquisition pipeline there and plenty of opportunities for us to evaluate. We ended the financial period for 2023 in a very strong position with a strong Solvency II balance sheet that provides ample headroom for M&A, and we've continued to make progress with our sustainability agenda, setting new interim targets as well. And we also celebrated our 20th birthday, Brian, as well, which we're proud of as well. So probably with that, that's enough from me for just now, and I'll hand back to you for the Q&A session.
Thanks, Steve. So I've got a few questions that we just want to dig into some of the sort of details a little bit. So thinking about the operations, for the first time in a few years, Chesnara delivered a positive operational experience in 2023 results, so beating the expectations. Can you maybe tell us a little bit more about what has turned that round and how confident can we be about that position going forward?
Yeah, so what you've seen in the results for this year, we've seen some of the benefit from the acquisitions that we've made as they've got into a more steady state position. So both from Sanlam and from Conservatrix. That also gives us a kind of more stable operating position going forward when you've been going through that period of integration and transition. You're spending a little bit of money. So when you look at the results, we've seen the benefit of that coming through. There'll always be kind of ups and downs to an extent within the numbers, Brian, but we're certainly positive about the outlook of the kind of financial performance. I think we do see other opportunities potentially to look at further synergies that we can make off the back of the deals and some operational simplification that might be available to us as well. I mean, what I would say, if you think about the last two years particularly, but actually over the last period, we've had to deal with very, very volatile market conditions. We've been dealing with quite high rates of inflation. So the fact that you've seen some small operational experience adjustments probably shouldn't be unexpected, but overall I think the financial result of the business over that period has been very strong.
Yeah. So you mentioned about the challenges in the past couple of years, and I think new business is an area that's probably experienced those perhaps more as dramatically as some, especially in Sweden. Can you tell us a little bit about how you see the prospect for new business, both in terms of margins and volumes?
Yeah, so those of you that have and you've obviously followed us for a while, Brian, but other people may have followed us for a while. We were dealing a couple of years ago with a very kind of competitive dynamic in Sweden, particularly some rather aggressive pricing from a competitor in that market, and as well a probably shift in broker behaviour that was leading to a kind of higher level of transfers out. We've seen that kind of stabilize, certainly from the kind of higher positions that we saw, albeit I think we are still seeing broker activity looking at that kind of transfer out activity. And you had that at the same time as a kind of a COVID market where brokers were just being less active on the new business side as well. So when new business come down a bit, you had this transfer out issue as well. If you look at the results, we're still writing profitable new business in Sweden. We'd like that to be a little bit higher. When we look at 2024, I think we're seeing more momentum on that new business side in terms of kind of new flows coming into the organization. I think we'll still see kind of transfers being higher than you might have seen historically, because I think that's just the dynamic that we're now seeing in the market. And it does remain quite competitive on the pension side, but we're still confident that we'll write profitable new business in that market. And Sarah and her team are certainly making good progress with some new distribution partnerships and things which hopefully will add to the new business result as we see it during the year. So that hopefully gives you a sense of the dynamic in Sweden. I'll maybe cover the Netherlands very quickly as well, Brian, in terms of the other main new business area. And you've seen the main product that we write in the Netherlands is term insurance, and there's quite a strong correlation between the writing of new term insurance business in the Netherlands and the housing market. And you've seen quite a big drop in the number of new housing sales happening in the Netherlands for a whole bunch of reasons. We haven't really seen that pick up at the start of 2024. So again, I think we're quite comfortable with the sort of margins and things that we're writing, but I wouldn't expect there to be a big uptick in the new business volume there in the short term, just because of that correlation to the housing market. But at kind of 10 million of new business for the year, we still see that as attractive for shareholders. That obviously adds to the economic value of the group. That's around, roughly speaking, about a third of the dividend, to give you an idea of the quantum. So we think that's still very much worth our while looking at that new business activity, and hopefully we'll see some further positive momentum from both of those businesses over the next few years.
Well, hopefully, yes. I'd like to turn to sort of the capital and cash, and we've sort of mentioned the sort of dividend growth rate, which has been kind of 3% for the last few years. And I think there's one or two observers thinking you've got strong internal cash generation, good prospects going forwards. We've seen a couple of years of high inflation, which I think is what people benchmark against. How do you think about the dividend growth rate, and what might lead you to consider changing it?
Sure. Why don't we give our new group CFO the chance to answer some questions? So Tom, can I hand to you for this?
Yeah, no problem, Steve. Thanks. Look, Brian, I think the first thing to say, it's quite important to look at this over the long term. So we're a long-term business, we're long-term investors, and we manage long-term liabilities. But actually, if you do look at it through that perspective, I think one of the previous slides showed that we've delivered something like just over 100% growth in dividends over the last 19 years. And that actually compares to CPI growth in the UK of about 70%. So over that long-term horizon, certainly delivering returns to our shareholders measurably in excess of inflation. I think then the question is, as you look forwards, again, one of the slides we showed earlier just demonstrates that we have predictable, sustainable sources of value into the long term, and we're confident that we can continue to deliver that progressive dividend policy. And if anything, that will become, I feel, more attractive actually as we kind of hopefully get to the end of this inflation cycle and we start seeing, particularly in the UK, inflation rates really moving towards that long-term Bank of England target. So I think, two things. I think it is a long-term perspective, but I think, over that long term, and certainly as we move forwards, I think we'll continue to deliver what I would regard as actually pretty attractive dividend growth rates versus prevailing inflation.
And last year, you added some mass lapse reinsurance in the UK business. I think the structure of that kind of illustrates the sort of things you might do in the future. So you can perhaps explain the decision-making process behind that decision.
Yeah, again, I'm happy to take that one. Just for people that aren't potentially aren't aware of what mass lapse reinsurance actually is. So under the capital requirements, we are required to hold capital for some pretty extreme lapse scenarios, certainly lapse scenarios we wouldn't envisage in the normal course of business. And there was a market opportunity for us to pass that risk to a third party for a relatively low price. And what that allowed us to do was remove that capital buffer from the balance sheet and give ourselves more flexibility within the balance sheet. And that then allows us to improve the solvency ratio and then make some decisions about whether we return that to shareholders or whether we deploy that for other opportunities like M&A. So strategically and from a balance sheet management perspective, it was absolutely the right thing to do at the right time. There are opportunities for us to do more of that. We have balance sheets in different jurisdictions that could benefit from more actions like that. But I would say that is just one of a whole menu of things that we do tend to look at from what I would call a capital management perspective. So there are reinsurance activities that deal with more extreme events. But then we have other BAU actions, which really just look at the ongoing efficiency of the back book. So expense efficiency, certain actions we can take on the liability profile, such as other reinsurance actions, but also actions that we can take to improve the asset profile of the balance sheet as well. So we will take decisions depending on market conditions to change our asset allocations to improve returns. So what I would say is you should look at the mass lapse as one example of a whole range of things that we do consider on an ongoing basis to optimize the balance sheet. And actually, that's why we have confidence in our ability to signpost that as a future source of value. Steve talked about that a little bit earlier. We actually see that as a very significant contribution to future value. And again, something that gives us confidence in our ability to support an ongoing progressive dividend policy.
Excellent. I'd like now to turn to M&A. And although you sort of have a very strong balance sheet, you have also mentioned the possibility of doing deals that involve equity for for larger transactions. Can you maybe explain why this might make sense to shareholders, given that the shares currently trade at a discount to economic value?
Yes, I think if you look at the slide that I stepped through, Brian, we're kind of pointing to a number of sources of potential firepower that we have. Mm-hmm. So we've got lots of liquid resources there available, and that 200 million level that we're kind of pointing to there in terms of immediately accessible firepower is about half the market cap. So we see that as good a material firepower. We're conscious that probably over the last 12 months or so, we have looked at some opportunities in the kind of 100 million to kind of 350 million consideration sort of range. And at that level, we clearly don't have the cash resources immediately available on the balance sheet to support that. And that's why we'd need to look at other sources as well. And I think if you looked at that on a blended basis, provided that the return was correct, was at the right sort of level, actually using some additional debt and/or a little bit of equity as well to allow shareholders to get access to a broader deal that's got the right returns for them could make a huge amount of sense. Now, clearly, we'd need to be absolutely convinced that the returns were available both on an economic value basis, and you saw the cash coming through of those things as well. So that's how we think about kind of the financing package in the round. We're in a fortunate position that when we think about some of those financing considerations, we don't have a very obvious short-term constraint. We've got lots of solvency headroom. The leverage ratio is in a good position. We've got good cash reserves. We've got this revolving cash facility that's available to us as well. So that's a great place for us to be starting from. But what we also did want to signpost is one of the benefits that we should have as a UK listed company is ultimately that at the right times you can go and ask for more money from your shareholders.
Mm-hmm. Yeah. I think it's fair to give people warning, just in case. So I think our time is up for today. So I'd like to thank Steve and Tom for their presentation and insights today. If you want to read more about Chesnara, you can find our latest research note, Good 2023 Results Set Platform for Future Growth Progress, alongside all of our reports at our website at hardmanco.com. To get all future Hardman Talks videos, just press the subscribe button. Thank you very much for listening and watching, and we look forward to being back with you in the near future.